Hey, welcome everybody. My name is Randy Tate. I am the CEO and one of the co-founders of iFlip Invest. And today we're going to be talking to you guys a little bit about AI. In particular, we're going to focus on how AI is disrupting and participating in the financial services arena. And I'm going to give you some very specific examples of how that's working, what's going on with that. And from there, we should, we're just going to take you through the whole process to talk about what it looks like and who we are. And we're going to see some real world examples of AI working. So the whole time today, we're going to do just a couple of things. Like I said, we're going to really dive into the world of algorithms. And one of the things we're going to really differentiate for you is that algorithms are not AI. A lot of people promote an algorithm as AI. They're not the case, and I'm going to explain a little bit to you using cross-functional industries, not just the financial services space, to get it started. And then we're going to dig a little bit into the financial services space. We're going to talk about that landscape and how it's flawed. We're going to talk about the two major problems with it, and AI fixes both of them. And then at the end, we're going to have a conversation where we're going to show you AI at work. In particular, we're going to give you some really good examples and show you real actionable trading that was going on that the AI was doing through the COVID experience. And that'll take us through the entire time. We should be, 30 to 45 minutes here. We don't want to keep you here all night. Just want to educate you and get you guys up to speed. Now, who are we? People always want to know who's talking to you. Well, we have a leadership team, a core leadership team of three of us. That's me in the middle there. I'm Randy Tate. I've been a consumer software expert for a while, helped Infusionsoft grow 60 to 100 million, been an executive consultant at a lot of different companies and sales and training and things like that. But this leadership team is the reason we're able to solve these problems, because all of us have specific backgrounds that are very different. Kelly, the gentleman on the left there, he's going to be speaking a little bit later tonight as well. He is a gentleman that, I always say it, everybody laughs, but he went to Stanford's physics program when he was 16 years old. He ran risk management at Deutsche Bank, where he had $4 billion under his tutelage there. He's been a portfolio manager for places like Brevan Howard and Tudor Group, and he is an all-around Wall Street mathematical guru. He is the brains behind this particular AI. And then Doug Adams, our COO, he is in charge of sales, market operations, and in product development right now. He's spent 30 years in corporate running operational strategies, and he keeps everybody on track with what we're doing. So just so you know who's at the top of what we're talking about, I want you guys to really understand that this leadership team has a lot to do with how we're able to change the world of finance. So you heard me say it earlier, algorithms are changing the world. Math and technology are driving change across almost every industry. Every place from how you get your entertainment to how you drive your car, how you invest your money, and especially with COVID, it's even getting bigger. So let's look at a few examples. Places like Google, Amazon, Uber. These guys are all using algorithms. No one can escape them. They're ubiquitous. And what I mean by ubiquitous is that everybody knows what's happening there. They're everywhere. You can't get away from them. They're overrunning everything. So algorithms are definitely everywhere. Now I'm going to use an example that's not financial services here in the beginning, just because I want you guys to understand that AI and what it's doing, it really is changing the fundamental landscape, not just in financial services, but across industries. And Blockbuster was one of the very first recipients of that happening. Blockbuster isn't the reason AI exists, but they are part of the evolution as to why it exists. So let's real quickly look at their business model. The company goes out, picks and buys millions of movies. They then put them on a truck, transport them on a train, whatever, to a bunch of stores. So now you got 9,000 stores. You got that going on. Then you got to inventory those things and rent and resell those things. So when you're looking at 9,000 stores and 84,000 workers, all driven by those customers where they drive to one location, they peruse movies, rent, one might be rented already, you don't know if you can get it, they need to return the movie on time or they get a penalty, but it takes an army of employees and puts a big strain on the customer just to get a movie. Now let's look at Netflix's model. Netflix, much simpler. They make contracts for content and creation. They either buy other people's content or they create their own. They have a simple access to stream from one cloud storage facility, and then they adjust the content accordingly. That's what their AI, their version of algorithms does. It adjusts the experience based on who you are, what have you done, what have you seen, to make it easier for you to see it. So the customer just opens up their app or their phone, they look at the movies, watch them, one monthly fee, as many as they want, no late fees. So the customer experience got much better because of algorithms. And really, Netflix has more subscribers if you break it down, simply because they're faster, they're easier, the quality is better, and they're simple. If you look at those 5 or 6 items down there on the competitive edge, how can customers stay loyal to Blockbuster when they've got a faster, easier, better, simpler, more functional place to go? And when you look at what happened in that short amount of time, that is because of algorithms and their ability to automate and technology. Now, let's switch the page here. Let's get into the world we're all here to talk about. Algorithms are changing the investment world. We know this. Wealthfront, Fidelity, Acorn, these are all companies using them. And as we're going through this call, if you have questions or something pops up, throw it in the chat. You know, we've got Brad, we've got Lee on here, a couple of our folks. They'll be happy to jump into that chat and answer any questions you might have. They'll be, really happy to talk about that. We want you to get all the experience out of this you can. Should have mentioned that at the beginning. Sorry about that. So these guys are all using algorithms. The industry itself is really trying to reinvent itself. But when you look across these companies right here and what they're doing, they're the equivalent of new lipstick on the same pig. This is not disruption, what they're doing. They're not doing to the financial services world what Netflix did to Blockbuster. Now, we look across the landscape, and it's flawed. You've heard me say that a couple of times. This is one of the last major industries to receive an overhaul. But now, because of technology and education, we can remove some of those flaws. So what are the flaws and what do I mean by that? Well, let's look at this. The landscape has 2 big issues. Number one, the approach. It's very dated, right? The professionals, the guys at Goldman Sachs managing, ginormous hedge funds, right? They have different tools than you do. They're not sitting there on their E-Trade, or they're not dropping their money off at Fidelity. They are actually using different tools. The average investor doesn't have those. The other piece, and I'm going to talk about this for a second, is based on a myth, right? There's a myth that diversification is the best way to reduce your risk, and that goal-based methods are the way to achieve those goals. Those are really old methodologies, and they expose the investor to tremendous risk. So as an average investor, what are our choices for an approach? Well, we could go to a traditional advisor and get our money put into things like mutual funds. We're going to be subject to the whims of the fund and the risk that comes with it. Along with, if you look at my second point, the fees. The ambiguity around fees are significant. There's a lot of ambiguity around it. Few investors, if any, can ever tell you what they actually pay if they're in a professionally managed environment. Large institutions, they promise transparency, but they really don't follow through with it. They're not giving you what you need. And most people on this call, you probably can't tell me how much in fees you paid last year if your money's in a traditional advisory place. So when we look at it like this, we say, well, this is terrible. I'm going to go do it myself. Okay, great. I'm going to go get a Robinhood account, or I'm going to go get E-Trade or a TD and manage my own platform. I'm going to do it myself. I'm going to spend years learning how to trade and become an expert at it and spend all day doing it. That's our options till now. Because those options are painful for the customer, expensive for the delivery side of the house, they become ripe for disruption. This space is very, very ripe for disruption. And this is where the AI starts to come in. And when you look at the waves and how this has happened, light bulb's going to pop on for you, because the disruption has already begun. Well, sort of. So the first disruptive wave is the robo-advisor. The robo-advisor, and we call it the myth. This is the Bettermonts, the Wealthfronts, the M1s, these guys. The robo-advisor was built to help reel in a new generation of investors and those who had been burned or even disappointed by Wall Street. While it is a legitimate innovation from a product experience and user acquisition standpoint, it's a false promise that's been fueled by a 10+ year bull market. Really, they're not doing anything different. There's no active management. It's passive. It's put in a bucket based on criteria where you checked a bunch of boxes about how old you are and how much risk you want to take. Outside of the onboarding and then the new experience, the actual foundation of it is no different. The second wave is that big millennial lure. Robinhood, Stash, Acorns. These are companies designed to attract millennials. With a gamification, do-it-yourself model, it encourages investments in high-risk, low-value companies, lots of trading, get it yourself, do all this. They're great at acquiring customers. They're not great at helping those customers do anything to grow their wealth. And the third disruptive wave is the democratization. This is where you can crowdfund, so to speak, where a small average investor can put a lot of money or a little money into a big project. It's helping the future investor get started by owning a small piece of a bigger deal. Interesting, pretty neat, but not disruptive. So what's disruptive? Well, you heard me talk about algorithms a lot here. So let's just get on the same page about what an algorithm is. Algorithms by themselves are innately limited in scope. They're often performed by computers. This is important for you to understand. An algorithm cannot change its own rules. A human must do that for them. And if you say, okay, what does that mean? Well, that means the algorithm, you as the human tell the algorithm, if this happens, do that. And if something else happens, do this. And then it can be automated, or you could even do it manually. In our space, it looks like this. So if you look over here where my cursor is, we talk about undesired data going into that algorithm. And here's the definition again. It's a clearly defined set of steps and rules. It doesn't change. That algorithm then takes that data, plugs it into the formula, and kicks out new data in a desired form. Now, this can be automated by technology. The technology can then do what the data says to do, or we can do it ourselves. So when we get on the same page about this, an algorithm is just a set of rules that keeps us from getting emotional. It's a big step. It's a long way, though, from AI. Algorithmic intelligence, or AI, is a process or rules to be followed, just like an algorithm, except the difference is it has the ability to change its own rules. This is all about that. And when we have the ability to change rules without having a human do it, we have what we call AI. So remember this, we talked about this. Well, think of it in a double step. AI is actually this up here. AI is this happening. It's an input data that's undesired. It's an algorithm attached to it, and it's data getting kicked out. However, this particular algorithm gets new data regularly because it's coming from another algorithm down here that's running all the time. This is what our software does. There's algorithms running in the background giving new information, allowing this particular algorithm to change its rule. So the data getting kicked out today isn't necessarily the same as it was yesterday, and it doesn't require a human to go in and change it. And then you have technology automate. That's the biggest difference between AI and an algorithm. There are a lot of companies, a lot of things going on where people are talking about AI. Well, it's not the Terminator, and it's not fully, sentient doing its own thing. AI simply means we have intelligent algorithms that have the ability to change their own rules without human interference. That is what AI is. And as Kelly likes to say, algorithmic intelligence, if you want to use data to predict the outcome of a future event, algorithms will beat out humans every time. And I like to say only every time. And so this is what we're talking about. And I know that was a long overview, 15 minutes for you guys. Hopefully that paints a really good picture as to how the AI actually works. Now let's look at it actually working. So what I'm going to do now, if you guys remember me talking about Kelly in the beginning, he's our Chief Technology Officer, co-founder, the brains behind everything we do. What I asked him to do is to come in and teach a little bit about how the AI learns and adjusts the risk parameters of the investment with the intent to miss those great big dips completely and then allow you to take on more upside. So I'm going to introduce Kelly and have him come on. I don't know, is he muted? Kelly, you on here?
Yes, I am.
Oh, perfect. So Kelly, welcome to the webinar. Thanks for coming on here tonight. And I know there's a lot going on here. Me and Kelly joke about this a lot. To me, this looks like a drunk chicken stepped in ink and walked across the road. This makes perfect sense to Kelly, and he understands it. So he's going to explain it. I'm going to use the cursor and try to follow along. And point out what he's looking at, and we'll go from there. So Kelly, talk us through what we're looking at and how AI is at work inside of here, and show us where we're winning and losing and how we're beating the market here.
Okay, Randy, thank you very much. Hello, everybody. I think for anybody out there that is used to trading themselves, I think what you see before you is something very common. It is a bar chart of the S&P 500 spider. The spider, of course, just represents the S&P 500 as a proxy. It's a tradable index. What we see here is it's just going back to a small amount of history, back to the middle of 2018 through almost current. And what we see, and a lot of people who have certain kinds of software platforms might notice all the various lines on there, which is very typical of what a trader looks at when they want to make decisions as whether to buy or sell. So just a quick outline out there for everybody, just notice the three things. The blue dots that you might see, Randy just pointed a blue dot, they represent a buy signal. A red dot represents a sell signal, which is exiting a position. The little tiny red dots over on, like those, represent the risk level. So those are things that are just drawn on the chart for convenience and for this demonstration and webinar that we're doing today. So a lot of these things are features that you can see anywhere. But behind the scenes here is, why are those dots where they are? Now, a simple algorithm could make those dots. Many people might understand that you can actually design these things if you know how to program a little bit, and you can say, let's buy the market and sell the market because of certain rules that you like. And that is fine, and you can back test it, and you can come up with a result that you may or may not like. Now, beyond that though, instead of building a fixed algorithm that will put those blue dots and red dots and little tiny red dots wherever they belong, like they are in this chart, imagine another algorithm that is running alongside of it that is actually changing not only just where those blue dots are, but also where all those lines are, based on the most current information that comes into the market. So what AI is the expansion of a simple algorithm into a more complex one that is putting together and pulling together a lot of data points. Now, there's many ways to do this, but ultimately it boils down to a statistical approach as to what is the most likely event that the user would want to see, in which this case, the user wants to see a profitable equity curve. And then also in this case, the user needs to see signals that give him an ability to buy the market strategically at good prices. In other words, try to buy lower. And of course, when they go to sell, try to sell higher. So the AI component is just another algorithm that is based on statistics that runs behind the scenes adjusting fundamental algorithms. It's the same thing that you would see when you open up your Netflix and you want to look at the movies you like to see, and it always seems to show you more like these. In other words, if you watch The Terminator, you're more likely to watch other sci-fi movies, and that's why they have them there. And then they show similar aspects of those sci-fi movies, whether it's the same actors in the sci-fi movies. In other words, so that you can see something that has a higher probability that that is something you would watch. Well, the same thing is true in navigating the markets. But in navigating the markets, it's all about risk and reward. So the idea of AI in terms of modeling a financial market, in this case, a time price series, is to find out where the basic buys and sells should occur, and then look for the most highly probable event that will allow you to place your buys in strategically good areas, in your sells, and also strategically good areas. So here's an example. There's two examples here in the chart, and that's why we took this. Part of it is for the nature of our company, being just a few years old, and we've already been through two crises. The dip you see on the left is the 2018 fourth quarter meltdown, where the market went down 20% literally in December. And as you can see, there's a little blue dot at the very near the bottom of that area. And it looks to me like that blue dot bought because of something by that little red line to the left. And that's because the AI at that time was able to draw that little red line that you see coming in by the blue line, because it understood where risk and reward was changing, which is simply a measurement of statistical variability around a long average price series. And as you can see, that was a very good buy. As then it held the market and it adjusted, in this case, that risk level, which is simply a stop area. In other words, where we would get out of the market should the market retrace. And it went up, and as you can see, it came up, and then we got out, and then we immediately went back in. And we held. Fast forward, so that was a very good trade, great. Later on, go all the way over to recently let's go to COVID. Under COVID, we also had a sell signal. Notice something about why we had a sell signal there back in February. And if you notice the little red dots to the left of that cell that Randy is pointing at. Notice how tight they are to the market. Why is that? In other words, at that time, risk and reward was not viable. In other words, the market the algorithm understood that the market would probably go higher, but the risk reward was not equitable to be able to hold a lot of risk in that particular trade. That's why the red dots occurred very close to the time series at that time. Then the market came down. The algorithm AI pulled us out. It tried again a day later to buy it, and then again 2 days later it sold it. Then it waited literally another 10 days or so, and then we bought the market again. Notice this time though that buy had nothing to do with the little red line that was close to it there. There you go, Randy, that little red line to the left. There you go, that one. In this case, it had nothing to do with the red line, and that's because the AI understood ahead of time that this had nothing to do with lines. It had to do with probability. And the probability was that that was a good place to enter the market. That trade was held, and as you can see, it was kept cleanly for a couple of months, and it essentially remains long to this day. So flip users were able to experience, in this particular case, long 242 on the spider, which today sits at around 340 approximately today. That's 100 S&P points since the middle of March. And obviously, if it was at 242, we've added 100 points. That's approximately a 60% gain, and explains why flip this year in our tactical model, which is this one, is up approximately 30% on the year and outperforming the S&P by approximately 28% or so, or 25% or so. And so the key thing to take away from this chart is that the little lines on there that you see are actually being changed. And you can't show the change historically because the way the algorithm works is it changes the underlying algorithm as well historically. So in other words, we don't even know the historical result of the underlying algorithm because it's changed by the AI that sits on top of it. And that is really what we think of as our flip edge. I feel that anybody can make an algorithm, but adding the intelligence behind how to manage the algorithm, that is something very unique. And that is something unique to Flip Investor. So in a nutshell, what you see before you is the result of a lot of hard work, many years of coding, using fundamental algorithms that are constantly being tweaked statistically, given drivers that are underneath all AI processes. And I won't go into all of those. That's very consuming and mostly for most people difficult to follow. And that's for another presentation for those of you who are interested.
Yeah, thank you, Kelly. That was really good. And I want to put on there, when Kelly's talking about the way our AI does it from it's fully automated. It doesn't send a signal for you to go to your phone and buy or sell something. It actually executes and does it all for you. And for those of you that are on here who see this as a little bit of an overwhelming chart, let's look at it in a little more simpler view. So here's what it looks like comparatively when we compare a couple of different things. Again, we're talking about the S&P 500. If you look at the blue line, this blue line is the S&P itself. If you bought it, you held it. The orange line, you notice, looks exactly like the other chart because this is the software. This is the AI doing the trading for you. And then the gray line, this is one of those funds. It's a fidelity fund. It's a mutual fund that people are paying a lot of money to be in. And you notice, remember I said earlier that diversification creates risk? Well, it creates the risk of becoming exactly like the market. And if you compare that directly to the market, then you're in a bit of a like, wow, I might as well just own the market and not pay any fees. So when you look at all of these across the board over time and in times of crisis, like I said earlier, the AI beats the human only every single time. So as you start to look at this and you see, well, but Randy, I need to demo this for 30 days and make sure your software would work. Okay, fine. What if it's these 30 days or these 30 days? That's not the idea. The idea is to manage the risk associated with the investment while being able to participate in the upside that the market gives you. Now, the last slide I'm going to bring, and I'm going to let Kelly come back and explain this one as well. When we start looking at losses, when you look at a market crash and start comparing the big losses, there's been 8 of them now with COVID since 1987. So when you are able to avoid those, Kelly, can you just take a minute and maybe not talk so much about AI, although we know this would be a result of the AI. Why is it important to skip those big drops and not try to say short everything or, you know, play a different type of game in it, but to actually skip those big drawdowns?
Well, fundamentally, we at Flip believe for now that most of our customers, but not all, have retirement accounts. Most retirement accounts are not allowed to short the market. Obviously, there's other vehicles that can be used to short the market, but shorting the market isn't really what is necessary. The big thing to think about, I think, for everybody, and the fundamental reason that Flip exists, is to, aside from grow your capital, it's to protect it. And so protection of capital is not done through diversification. It's done with sound money management. Our money management is coming in the form of AI. That's it. And the idea is if you can step aside and lose less when the market is under duress, which it is typically, as you can look through the years of this from the 87, 90, 98, 2000, 2007, et cetera, that the market will always be under duress. Very quietly, for example, recently the Apple has lost 20% of its value right after its split. A lot of people don't know that it just lost 20%. Yes, it went down, but it went down 20%. That's a lot. Somebody lost 20%. But the idea is that if you buy and can step aside of the market when it's going down and wait for a more strategic entry point, that means that not only do you have better risk reward characteristics on your current trade, but you're able to outperform the market over time. There is no way to outperform the market by taking profits. The way you do it is by reducing losses. Remember that. Taking profits is one way to do it, but it is not something that can be done accurately over time because the market has a way of always exposing each and every individual's weakest point. So it will always inflict the greatest pain to all participants to put them to the point that they can't bear it. So rather than try to figure out if the market is at the top, it's better off to try to just keep in the market and pull yourself out of the market when the market is under duress. And as you can see by the data in front of you, that the way our algorithms work and the way the AI manages those algorithms is through each individual crisis. And by the way, the last three of them, the current AI is being used for the Brexit one, the trade war 2018 and COVID, because that's our existence. Those are examples of how we've been able to step aside risk and able to buy the market at a more strategic entry point and outperform over the last 3 years. So over time, the best way to outperform the market, and this is the summary, is to step aside as the market goes down, because it will always do that at some point, and then find a re-entry point that is better and more defendable. And that is how you're able to beat the market.
Perfect. Thank you. Thank you. People don't realize the importance of skipping those dips and how there could be significant lapses of time between them. You look between Brexit and the trade war, it's 3 years, over 3 years between those times. So it's the big volatile dips that you want to avoid. The little ones here and there, that's how the market goes, but that's what the AI is for, so to keep us from becoming emotional and panicking. So the bottom line is this, right? If we look at what's going on in this particular industry, that the financial space is ripe for disruption. And AI is more efficient and more effective than a human. You know, we set out to build this thing back in, actually, I think we started dabbling with the idea and the concepts here in 2015, Kelly. And We spent a lot of time doing some product market research, Kelly doing tons of mathematical computations, building out all kinds of stuff to find a way to disrupt this industry, similar to the way Netflix disrupted Blockbuster. We wanted to be better. We wanted to be easier. We wanted to be simpler. We wanted to be cheaper. And over this time, we've proven it. Our model is working. People are, as Kelly said, over 25% ahead of the S&P 500 for the year. If we're just equal to the S&P 500 without the risk, we're happy. And so we want to really stress that to you guys. Now, as we wrap up the webinar, the intent of this was to help you guys get a basic overview of AI, how AI works, how AI is going to change the market at scale. And we want to invite you to a demonstration of our software. Not a sales pitch, an invitation to a demo. You got two ways to do it. You can text that word invest to that number, it'll give you a calendar link. And if you schedule a call, it'll be a private webinar with Brad or Lee, the folks I mentioned earlier. They'll get on a webinar with you. They will walk you through an example and a demo of the software live, what it's doing, how it works. Anybody can use our software. It is designed at the lowest level of execution and the easiest to learn. You can set it up in less than an hour, and then it runs automatically. We have platforms for people, whether you got 200 bucks or 2 million. Our software can handle that. It has Smartfolios designed by Kelly that are AI driven for every budget. Like I said, you got 200 bucks, you got 2 million, and you want to invest, you can do that. Or if you're a web person, you can go to the iFlipwebinar.com and you can schedule an appointment there. But I want to encourage all of you to come check it out, learn more, become educated, get it figured out, because the percentage of people in this particular country that are not going to be financially stable by the time they get retirement age is amazing. Only 29% of the people over 65 are in that position now. Most of them have less than 10 grand in total retirement accounts. So again, folks, my name is Randy Tate. Thank you so much for jumping on the call with us. I hope this was informative. We intended to make it short. If nothing else, shoot me an email, randy@iflipinvest.com. Let me know what you thought of it. If there's more information you want, if we talked too fast, gave you too much, we just want you guys to be able to benefit from this. Thank you very much. Have a great night.